If you've spent time researching retirement planning, you've probably been pitched one of those two products. Sometimes both, sometimes by the same person in the same meeting. Index Universal Life Insurance, or IUL, and annuities. Both are sold with similar promises: market linked growth, downside protection, tax advantages, lifetime income. They sound almost identical from a distance, which exactly why so many people get confused and why so many people end up buying the wrong one. Today, we're putting them side by side and having the honest conversation that most salespeople don't want to have.
This is Kingdom Cash Flow. Here is your host, May Dungo.
What are these products actually doing with your money? What do they really cost? Where does each one genuinely shine? And where does each one quietly disappoint? Because here's the truth: one of these is primarily a wealth building tool, the other is primarily an income protection tool. And mixing those two things up can cost you years of financial progress. Let's sort it out. Before we get into the head to head, let's make sure we're clear on what each of these products actually is, because most comparisons skip this step and that's where the confusion starts. An Index Universal Life Policy, or IUL, is first and foremost a life insurance policy. You pay premiums, a portion of those premiums goes toward buying a death benefit, the payout your family receives when you die, also living benefits. The remainder goes into a cash value account that earns interest linked to a market index like the S&P 500, with a floor protecting you from losses and any cap limiting your upside. Over time, that cash value can grow substantially and you can borrow against it tax-free during your lifetime. An annuity is a contract with an insurance company designed specifically around retirement income. You fund it either a lump sum or over time, and in return, the company promises to grow your money and eventually convert it into a guaranteed income stream, often for life. There's no death benefit built in by default, no life insurance component, and no premium going toward coverage costs. Every dollar you put in is working toward growth and income. So right away, these are not the same product. One is an insurance policy with an investment feature, and the other is an investment vehicle with insurance company backing. The overlap in how they are marketed is real, but the underlying mechanics are genuinely different. Keep that in mind as we go through each category. Let's start with the IUL and go deeper than most explanations do. When you pay your IUL premium, that money doesn't all go to work for you immediately. First, the insurance company takes out the cost of insurance, the actual life insurance coverage, plus admin charges. What's left goes into your cash value account in the early years of a policy. Especially if the death benefit is large, those insurance costs can eat a significant portion of your premium. This is the part that most IUL illustrations gloss over. The cash value growth, your cash value earns interest based on an index, typically the S&P 500. Like a fixed index annuity, you get a floor, usually 0%, so you cannot lose cash value to market downturns, and a cap, often somewhere between 8 to 12%, depending on the policy, limiting how much you earn in a great market year. Some policies use a participation rate instead of a cap. The mechanics are very similar to an index annuity in this part of the structure. The tax advantages. This is where the IUL genuinely shines. Cash value inside an IUL grows tax deferred, but more importantly, you can access it through policy loans that are structured to be income tax free. That's a meaningful benefit that annuities simply don't match. Annuity withdrawals are taxed as ordinary income on the growth portion. IUL loans, structured correctly, are not. For high earners looking for a tax-free retirement income, that distinction matters a great deal. The death benefit. The IUL also leaves behind a tax-free death benefit to your beneficiaries. That is something an annuity typically doesn't offer, at least not without an additional rider at additional cost. If leaving a legacy is part of your financial picture, the IUL delivers something an annuity structurally cannot: the real cost. Here's what the glossy IUL illustrations often don't emphasize: The internal cost of insurance increases every year as you age. In your 30s and 40s, those costs are modest. But by your 60s and 70s, right when you want your cash value to be compounding aggressively, those insurance costs can become a serious drag. If the policy is not funded aggressively enough in the early years, rising insurance costs can actually erode your cash value over time. Poorly funded IULs have lapsed on people in retirement, leaving them with nothing. That's a real risk, not a theoretical one. Annuities, how do they really work? Now, let's go equally deep on the annuity side, specifically the fixed index annuity, since that's the type most commonly compared to an IUL. When you put your money into a fixed index annuity, the entire contribution goes into your account, minus any explicit fees, which on a base product are often minimal. There's no cost of insurance being subtracted, no mortality charge eating your premium in 1 year. Your full dollar goes to work immediately. That's a structural advantage the annuity holds from day one. The growth mechanics. Like the IUL, a fixed index annuity credits interest based on a market index with a floor and the cap. The mechanics are nearly identical in this regard. The key difference is that without insurance costs being subtracted, more of your money is actually accumulating in the index crediting strategy year after year, over a 20 or a 25-year accumulation period. That seemingly small difference compounds into a meaningful gap in account value, the income guarantee. This is where the annuity separates itself decisively. An annuity, especially one with an income rider, is engineered from the ground up to create guaranteed lifetime income. The insurance company is on the hook to pay you a specific monthly amount for the rest of your life, regardless of how your account value performs. That guarantee is backed by the insurer's general account and regulatory reserves. It's the most reliable source of guaranteed private income available outside of a pension. The tax treatment. Growth inside an annuity is tax deferred, but when you take withdrawals or start receiving income, the earnings portion is taxed as ordinary income. If you're in a high tax bracket in retirement, that's worth factoring in. It's not a deal breaker for most people, but it's a meaningful difference compared to the tax-free loan structure of a well-funded IUL. What annuities don't do, they don't leave a death benefit. They don't offer tax-free income access the way an IUL can, and they don't provide life insurance coverage. So, if protecting your family is a priority, you need to address that separately, head to head, category by category. Now, let's put them side by side across the categories that actually matter for wealth building. Wealth accumulation efficiency. Over a long time horizon, 20 to 30 years, a well-funded IUL and a fixed index annuity with similar index crediting strategies will often produce comparable cash value growth. But the annuity typically has fewer internal costs dragging against accumulation, especially in the early years before the IUL's insurance charges become modest relative to the cash value. For pure accumulation with no need for a death benefit, the annuity is generally more efficient dollar for dollar. Tax efficiency in retirement. This round goes to the IUL. Clearly, tax-free policy loans versus taxable annuity withdrawals is a significant difference for anyone in a middle to high tax bracket. If you're building a retirement income strategy specifically designed to minimize your tax bill, the IUL has a structural advantage that's hard to ignore. This is one of the reasons why the IUL is particularly more popular with high income earners who have already maxed out their 401k and Roth IRA options. Guaranteed lifetime income. This round goes to the annuity, and it's not close. An annuity is purpose-built for this. The income guarantee is the core product. With an IUL, you can generate retirement income through loans, but it requires active management, ongoing premium funding, and careful planning to ensure the policy doesn't lapse. The annuity's income guarantee is simpler, more certain, and doesn't require you to keep paying premiums into your 70s to keep it from collapsing. Death benefit and legacy planning. IUL wins this one outright. A tax-free death benefit that can be structured to grow alongside your cash value is a meaningful legacy tool. Annuities can add death benefit riders, but they come at extra cost, and the proceeds are typically taxable to heirs, unlike IUL death benefit, flexibility and access. So the IUL has an edge here too. Policy loans from an IUL are generally more flexible than annuity withdrawals. No surrender charges on loans, no required minimum distributions, and the tax-free treatment gives you more control over your taxable income in retirement. Annuities are more rigid, especially during surrender periods. Simplicity and risk of failure. The annuity wins this one. An IUL requires careful management, premium funding, monitoring the cost of insurance, ensuring the policy stays funded enough not to lapse. A poorly managed IUL can collapse precisely when you need it the most. An annuity, once funded, is largely self-contained. The guarantee doesn't depend on your continued management, it just works. The conversation nobody's having. Here's what I want you to walk away understanding, because this is the part that most comparison videos skip entirely. Both of these products are frequently oversold. The IULs is often pitched as a be-all retirement solution, tax-free income, market growth, death benefit all in one. And it can deliver on those promises, but only when it's properly funded, properly structured, and managed by someone who actually understands what they're doing. When it's underfunded or sold as a set it and forget it product, it can fail catastrophically and quietly. The annuity is often pitched as the guaranteed income solution that eliminates all retirement risk. And it does eliminate longevity risk and market risk from your income floor, but it doesn't replace the need for liquid assets. It doesn't protect your purchasing power from inflation on its own. And it doesn't leave anything behind to your family by default. The question isn't really IUL versus annuity. The question is, what problem are you actually trying to solve? If your primary goal is creating tax-free retirement income, protecting your family with a death benefit, and you are willing to commit to funding a policy aggressively for 15 to 20 years, an IUL deserves a serious consideration. If your primary goal is guaranteed lifetime income with simplicity, lower management overhead, and protection against outliving your savings, an annuity is likely the more direct path. And for many people, particularly those with both a need for income security and a desire for legacy planning, using both in a coordinated strategy is actually the most powerful approach. Who each one is actually for. Let me give you a clear profile for each so you can put yourself in the right category. An IUL makes most sense if you're in your 30s to early 50s with a long runway to fund the policy. You're a higher earner, ideally in the 32% tax bracket or above, who would benefit significantly from tax-free income in retirement. You have dependents who need life insurance coverage regardless, and you're working with an experienced financial professional just like me who will structure the policy correctly from day one. Maximum funding, minimum death benefit, to optimize for cash value growth rather than insurance commission. An annuity makes most sense if you're in your 50s, you're in your 60s, and closer to needing income than to building a legacy. You want a guaranteed monthly paycheck in retirement without ongoing management. You don't have a pressing need for a life insurance coverage. Maybe your kids are grown, your mortgage is paid, your spouse is financially independent, and you want simplicity. A product that does exactly what it promises without requiring active stewardship to keep it from collapsing. So neither profile is better. They serve genuinely different life stages and financial goals. The danger is when a product designed for one profile gets sold to someone in the other, and that happens more than it should. 3 things you've probably been told that aren't quite right. Quick myth busting before we wrap up. Myth 1. IUL is basically the same as an index annuity, but better. Not true. The index crediting mechanism is similar, but the IUL has insurance costs running against your growth, and the annuity has a structural income guarantee the IUL cannot replicate without ongoing premium management. They're cousins, not twins. Myth 2. Annuities are always the safer choice. Safer in terms of income guarantee, yes, but annuities carries their own risks. Inflation erosion, insurer financial health, and the irreversibility of annuitization. Safe doesn't mean risk-free. Myth 3. You have to choose one or the other. Plenty of well-structured retirement plans include both. An annuity creating the income floor and an IUL providing tax-free supplemental income and a death benefit. The goal is coordination and not competition. So IUL versus annuities? Both are powerful. Both are legitimate. Both are frequently misunderstood and occasionally misused. The one that builds more wealth for you depends entirely on what you're building toward and how early you start. So if you're leaning toward an IUL, spend time with a financial professional just like me who can run an honest illustration, not just the best case projection. If you're leaning towards an annuity, go back and watch my video on why some annuities fail before you sign anything. Knowledge is the only protection that doesn't have a surrender period. Hit like if this helped you see these two products more clearly. Subscribe for more no-nonsense retirement content every week. And the full annuity series is right here if you want to keep going. Every video in that playlist builds on the last. And if you'd like a personalized guidance, I'll also put my calendar link below for a free 15-minute consultation where we can talk about your current situation and help create a customized blueprint for whatever stage of life or financial journey you're in right now. I'll see you on the next one.